Press directly.
24, 2024, 2024 was a year of instability, a year of extremes. It's said to be the hottest year on record. The challenge feels huge, yet solutions exist. There are cities, regions, businesses, schools, and community organizations the world over. Bold climate action is underway in big and small but significant ways. Leaders of all kinds are stepping up and rising to the challenge. There's a groundswell of momentum. Climate action is possible, popular, and profitable. Thanks to the collaboration of organizations across the world, we know what is needed to tackle the climate crisis at speed and scale across oceans, regions, and industries. We now know where we need to go next, together, to build a healthy, resilient, prosperous, peaceful world for all of us and our children to reach our clear collective climate goals by 2030. So whoever you are, wherever you're from, find out more about the partners and impact makers ready to collaborate and the tools already available to build ambitious national plans and take bold climate action today. Because tomorrow is too late.
Hello, everybody. Thank you very much for joining us at this very important event about insurance, how insurance can really help unlock capital. My name is Craig Pettingill. I'm with the Climate Champions team. We have an awful lot of information we wish to share with people today from a lot of different speakers. And I was told before we started this morning, there was no way we were going to get through those number of speakers. And I said, they all know how much time they have. So please, let's prove that we can do this, keep to time, and without any further ado, over to Barbara Butler.
Thank you so much. And this is, you have to.
Oh, sorry.
Okay. These 2 seconds were not mine. That was like yours, just that you know. Well, thank you so much. My name is Barbara Buchner. I'm the Global Managing Director of Climate Policy Initiative. It's such a pleasure being here with all of you, so many innovators, thought leaders, friends and colleagues who really share this journey with me and all of you. I think very briefly again, today, we know that global climate finance has been increasing. We know that there's some good news, and I think the video just now highlighted that one as well. We have crossed the 1 trillion threshold of global climate finance a couple of years ago, and our most recent estimates at CPI indicate that in 2023 we have between 1.5 and 1.6 trillion US dollars of global public and private climate finance. So this is progress, but we do know also that we need about 5 times more in order to meet all the needs that we see across the world. So there is an ambitious, hopefully, future in front of us, but I think ambition alone is not enough. We need to turn all the solutions, all the intentions into concrete and bold action. And this is where I see the power of the insurance industry really coming in. Rowan will be laughing. I have been saying for several years that the insurance industry is in a room, but not at the table. And for me, this is like different now. The insurance industry finally is at the table. So I really look forward to hearing from all of you on what can be done in order to unlock the potential from the insurance industry, but also from other partners, and really work together in order to scale climate finance, in order to scale finance for climate and development, and really making change happen. So thank you so much.
Thank you so much. Thank you so much, Barbara. Let's move on to Vanessa Chan, please.
Hi, I'm Vanessa Chan, the Chief Commercialization Officer from the Department of Energy, and thrilled to be here. Insurance is such an incredibly important industry because of the fact that you guys think about risk and finance are absolutely interlinked. And so really what I'm hoping, having spent time with Howden and others and the Geneva Association, is really think, how do we get less risk averse and be more forward thinking? Because in the end, for us to get to the clean energy transition, it's all about the financing gap that we have. And right now, everyone is first in line to be 8th or 9th. No one is first in line to be 1st, 2nd, or 3rd, because we know the 1st, 2nd, and 3rds are going to have a harder time being able to make money. So I think the key for insurance is, what's the role that you play when the risks are high and we're not yet at scale? And that's why I'm really encouraged by the fact there's so much innovation going on in the insurance industry. Here at the Department of Energy, we've been thinking a lot about risk beyond technology risk. We have something called adoption readiness levels that the Geneva Association found. And then what we were able to do was use that through the work with the Geneva Association and create a new insurance risk framework. And so what I'm hoping all of you will be thinking about is not the status quo way of doing things. In the financial institutions, we think about NPVs, IRRs, WACCs, all these hurdle rates that are artificially created. And what we need to think about is, how do we lower the risk to the point where we can all collectively take the risk together? And I think that really is the important point, is we need to collectively take the risk. So all of us are 1st, 2nd, 3rd, and we're financing the first 10 of a kind together, versus asking for the next person to do it first, and then we'll come right after. So thank you for having us here, and we look forward to hearing how the outcomes of you thinking transformatively will lead to us getting to a faster energy transition.
Wonderful stuff. Thank you so much, Vanessa. Let's move on to Rowan Douglas, please, of Howden.
Thanks so much, Craig, and it's lovely to be here. Lovely to welcome so many members of the industry, but also many from outside the industry, indeed the insurance curious. Thank you for being brave and coming here today. Some have asked, what is fundamentally the role of insurance in this transition? And I often say, well, it's about going back to the future. So, the last industrial transition we had was, ironically, the fossil fuel industrial transition. And the AI, or the wind turbines of the era, were steam boilers, which were transforming the world. Factories, locomotion, heating, and people were innovating and wanting to make money and transform the world, but they were very dangerous. And they became so dangerous that investors were losing money and insurers were losing money in the 1850s, and they came together with engineers and created the standards for safe boilers. It was called the Hartford Steam Boiler Company. Hartford Steam Boiler still exists. It's owned by Munich Re, and we have Julian Richardson from Munich Re here. And that insurability of boilers then enabled credit and investment to flow. And that's what enabled the Industrial Revolution to truly scale and speed. Ironically, 170 years later, we're reaping the winds of that first Industrial Revolution. So we need to do the same and de-risk the innovations that we need. And insurance is always a public-private partnership. There's always a partnership of regulation and shared capital, either through taxpayers or through premium. So then the steam boilers got going, and they led to mass urbanization, which led to the first resilience transition, because cities were burning. If you do your history, look at America in the 1880s, Chicago, New York. People were losing money, and they said, we need insurance. And the insurers got together and they said, well, you need, in that case, to reduce the risk, you need to have building codes and zoning laws and fire departments, and you need to use this incredible global product called reinsurance to share the risk. And those rules then dictated where investment and credit could go. And you rebuilt our cities over the next 50 years That was the first resilient transition, enabled again by the boring rules of insurance which shape capital. And then we needed the first just transition. We had that as we urbanized by the 1920s and 1930s. We'd all moved to the cities and in precarious jobs in factories, and social dislocation was complete. And we needed a social insurance revolution, which began in my country, in Britain, in the turn of the 20th century, in Germany a little earlier, in the US in the 1920s and 30s. And social insurance became the absolute bedrock of enabling what became a just transition. So between 1850 and 1950, if I can put it like this, the carbon revolution was and the impacts of that were entirely enabled through public-private mechanisms of insurance, where we share risk between geographies and between generations. And somehow, the last 50 years, we've lost that memory. And somehow, over the last 50 years, insurance as an enabling substrate of capital and credit has been disconnected from mainstream finance. It's taken 10 years, as Barbara indicated, to get to this point where insurance is now seen as a primary institution of the financial system and a primary mechanism to confront this challenge. I realize there's still a long way to go to take these important ideas, relearn them and apply them. But we do not have another 100 years like we had last time. We have 5 years to implement this agenda. And today I'm thrilled that the climate champions have released this report, supported by Howden and BCG, which in a very practical way illustrates how the resilient, just and net zero transition can be enabled through insurance unlocking capital. It's being announced today. We launch in a year's time when we have practical applications of this across most of the climate solution agenda of the climate champions and beyond. So thank you so much, Nigel, for helping to spearhead this agenda and for creating with others the Climate Champions platform to enable non-state actors like our industry to play our part.
Thank you, Rowan. Let's move to Junaid Ahmed from MEGA, part of the World Bank.
Good afternoon. Wonderful to be here. Rowan, you know, your description of the relationship between insurance and development is absolutely spot on. And we are now very much at a pivotal moment of how the insurance industry is going to play a role in today's development trajectory. And you're absolutely right. The World Bank is undergoing, I think, a pivotal transformation. Under Ajay Banga, our president, the bank is moving from being a lending institution to asking the question, how does it become a leveraging institution? Today, most of the capital doesn't lie in development finance. Most of the capital lies in market finance. So the question is, how do you actually tap into that market finance for development? And in particular, how do you tap into it for the transitions we need to address the climate change challenges that we're facing? It is in this context that one part of the World Bank is now beginning to play a greater role. It's the Multilateral Investment Guarantee Agency, which is an insurance agency. It was created in 1988 with $366 million of capital. It has never been further capitalized. That $366 million has been converted into $85 billion of guaranteed finance. Now, this shift, this leveraging has been a fascinating story. It's gone into infrastructure, it's gone into water, electricity, it's gone into transition. Now, what's fascinating is that for every dollar that we of our capital that we put into guarantees, we are able to leverage 46 times. So today, $760 million of our capital is backing a portfolio of $30 billion. Over time, it has been 85 billion. But the real, if you will, success of this leveraging power of MEGA has been the reinsurance industry. Because for every dollar we guarantee, 70% we reinsure. So because we're able to reinsure and the reinsurance market is able to take that risk from us, that 366 has been converted into $85 billion of guarantees over time. Now, let me give you a couple of examples of what we're doing. Recently, Codelco, one of the biggest copper mines companies, public sector in Chile, wanted to completely decarbonize. So it went into the global market to raise money, and it used a MEGA guarantee to raise money. So it raised $750 million, 20-year money to decarbonize. Now, what is fascinating is it's 10% of GDP. For Codelco to decarbonize, Chile has to decarbonize. You know, it's the impact of one company on the whole system. That's one example. Another example I'll give you is in India, the World Bank put in $500 million to State Bank of India to give a boost to solar rooftop, commercial and industrial solar rooftop industry. Within a few years, that industry just absolutely exploded with private sector. So when we came in with MEGA and we said, what if we could take that 500 million of IBRD development finance and actually swap it with the market? And we can only swap it with the market is by providing an insurance or guarantee underneath it. And SBI got a better rate than IBRD was able to give. Why? Because IBRD had helped SBI cover the greenfield risk, and we came in after the greenfield risk. So the rates that we were able to get from the market for SBI was much better. And what happened is that money then got released back to Ministry of Finance to be put into further investment in different development areas. We're now beginning to look at use of guarantees in a very important area. And this is something that's reflected in this excellent paper, The Great Enabler, in which the carbon credit insurance that the Howden Group has done, we're beginning to do that in a larger way. So the example would be today, Cocoa Industries is a firm that's beginning to do clean cooking across millions of households, especially rural households in Africa. The way they're financing it is by actually capturing the carbon credit. Now, the question is, there is no regulatory framework that ensures the carbon credit. And so what we're doing is providing an insurance guarantee to actually get cocoa to scale up carbon credit. We believe that this kind of insurance guarantee story to bring in capital finance is going to be the future of the World Bank. And what Ajay Banga has done is he's taken all the guarantees of the World Bank and placed it inside MEGA to make it one-stop shop. And for us, the challenge is, how do you take this one-stop shop and now begin to expand it? And one of the areas that we want to expand it is in partnership with the insurance industry that's out there. We're beginning to understand where the insurance industry is putting money into pandemic relief. It's putting money into disaster relief. And we want to see if we can actually partner with it in order to scale things up. But I have to tell you that our program of MEGA, which deals with non-commercial risk, political risk, is yet to partner with the insurance industry beyond the reinsurance industry in a way that we can see scale up. And that's where I'm really looking at today's dialogue. And I think that the Great Enabler has really positioned that debate. And I'd like to see us challenged to see how we can actually bring in the MEGA of today's MEGA with Ajay Banga's full support to actually reflect the type of partnership with the market insurance and see if we can scale up the transition that is needed in climate. That is what I sincerely hope we'll be able to get from all of you. Thank you.
That's wonderful. Thank you so much. And, when you hear 46 times and public-private, you know something's going well, right? Well done. Anna, I don't know if you'd like me to go first, or you're welcome just to head straight in, your preference. So it's Anna Rovzar from the Global Renewables Alliance. Thank you for joining us, Anna. And
No, hardly. I'm very sorry, hardly. Apologies for my delay. So I believe I have a little bit of time to highlight, let's say, some of the perspectives that we at the Global Renewables Alliance have been working towards, or let's say revealing over the past year when it comes to financing. I know we're here to discuss a very specific type of the role of insurance in particular, but I do want to zoom out for a moment because it helps us, at least at the GRA side, to get a better grasp of things. We're the global renewable industry voice at large. We represent 6 industry associations that bring together solar, the solar energy sector, the wind energy sector, geothermal, hydropower, green hydrogen, and storage, in particular long duration energy storage. So essentially, the entire rainbow of technologies on the renewables and variable side. So we really advocated for the tripling renewables goal last year. We were delighted to see that that became a pledge, and this year was all about translating that into action, in particular from the industry's point of view, because we have, we know that the onus falls on the private sector to get all built what government sets as a target for itself, and we are there at the table, very committed to do so. And if we can see and really focus on a few elements to work on in the next couple of years towards the 2030 goal, financing is absolutely one of them. What we've tried to do in the past year is to really try to understand what the challenges at hand. We've come up with a financing advisory group with some leading public and private voices on this to better understand where this challenge really lies. We know it has to do with access to capital. We know that in itself is inherently tied to risk and all types of risk. I know that you know this much better than I do. But we really did get to 2 insights that I want to share here. And then I think this is even an embodiment, this discussion is even an embodiment of that insight as we go forward. Because in our discussions, we see that there's a bit of a disconnect between the realities of government, industry, and financiers in particular to get those targets aligned, to get those projects built at aggregate, at large. We found that, for example, governments might not always know what the industry needs to see in terms of investment signals, and that's why we push for investable NDCs now in February 25. We know that financiers, of course, talk in a different language, have certain margins of maneuver that industry or governments might not always understand, and it makes it easy to call for trillions when, as policymakers or as advocates for this as ourselves, when we know that project developers and financiers themselves look at projects. They look at the millions or the billions that are necessary to get one project online, and the whole project finance cycle that comes with that. And where industry might, for example, be surprised is that perhaps not all investors know the full reality, technically speaking, at large on how renewables are doing, what the technological bottlenecks still are, which ones have been dealt with. So the idea of this trialogue is really important to us. And the second insight is that to get from the language of trillions to a bit more specifics, understanding really what the challenge is, we also wanted to look at not just the fact that we need financing, we all know this, but what kind of financing. And that brings up the question of debt versus equity ratios around the world, around different jurisdictions, around different markets that our industry partners are having, whether it's balance sheet financing and so on, but also our discussions with multilateral development banks that we keep calling upon to increase their mandates or expand them to be able to bridge certain gaps that otherwise we cannot fill. So it's a very important part of the discussion that we've been trying to crush some crunch, not crush, crunch some numbers, apologies, crunch some numbers on. And we realized that the big bulk of money will have to come from debt, but also a big role for equity. And these are different implications in terms of steering the debate to a more specific goal. So there's policy tools that are on the table, whether it's policy in particular on climate, trade, investment, energy. There's the financing mechanism on the table, debt and equity. There's de-risking instruments, and of course, getting towards guarantees here, getting towards insurance, getting towards the specific roles that blended finance can play, but blended finance 2.0, how we can get to an innovative version of that. And so we really want to have more discussions on precisely this. Industry should be aware of this as well, at large, as we call for these aggregate goals. I know that there is a lot of work that's been done that proves this fact. In fact, there are case studies that have been highlighted by the partnership, including Brightmark Energy, for example, that has looked at insurance, unlocking capital for technology, mitigating the risks of certain technology risks that we don't yet know that we really need to advance on quite rapidly. Secure source energy as well, where insurance has made finance for energy efficiency improvements, the doubling energy efficiency goal that we have, really stepping that forward. Even in emerging markets and developing economies. The Parc Éolien Taïba in Senegal has been a developing market wind generation project that was made investable by mitigating political risk through meager political risk insurance and really pushing the lever there. And also musical solar is another case study that has been highlighted where insurance made distributed solar energy projects investable through mitigating off-taker default risk. All examples that we are continuously called upon to give, I think where the partnership really helps us illustrate that further and where I think we can do a lot more going forward. And I'd like to stop here and apologize again for being late.
No apology needed, and wonderful job coming in at, literally straight up, and great to hear the top down and the bottom up. You need to do it both ways. Let's move on now to Kirsten Dunlop of Climate Kick.
Thank you very much, Craig. Hello, everybody. Good afternoon. I work for an organization called Climate Kick, as Craig said. The name is a little bit obscure, so I'll explain a little bit. The KIC refers to Knowledge Innovation Community. It's Europe's largest climate innovation agency and community, working across the world in nearly 60 countries, but with a very deep commitment to systemic change. So the transformation of whole cities, whole regions, and entire value chains and supply chains as one of the lessons learned over the last 15 years of our existence in order to get anything close to the speed and scale of transformation needed. And I'm going to provide one context to a piece of work we're doing into which I'm going to link the comments I make. In this case, I'll choose an example that is very, if you like, very incremental and close to home, but massively important in terms of the tipping point we're describing here. Let's take land transport, mobility, electrification of mobility, all forms of mobility. We know that we need to get to a point where the percentage of sales of new vehicles that are zero emission needs to be 85 to 100%. I would be arguing it needs to be 100% as quickly as possible, certainly within 2030. And a percentage of new truck sales getting to 60% as fast as possible and within 2030. I would also be arguing as much of a model transfer and a multimodal transfer of transport by 2030 away from private vehicle ownership and into shared and commercial and public and distributed transport. The majority of these zero-emission vehicles are likely to be electric for both cars and commercial, given the challenges of hydrogen. And looking firstly at cars, one of the purchase problems is that the price is expected to fall much lower than an internal combustion engine as nearly as early as 2024. So that's last year in Europe, 2025 in China, 2026 in the US, and 2027 in India for medium-sized cars, and even sooner for smaller cars. So price is not an issue. But buyer confidence in reliability, in predictability, in trustworthiness is an issue. And the issue there is related to battery performance, a lot of concerns about the ways in which batteries are performing, longevity over time, management of end of life, transitioning into new and into replacement and supply, or the bigger problem of electric infrastructure, one of the biggest issues of failing to innovate systemically. We have invested so much in end-of-pipe solutions and failed dramatically to invest it in a distributed, decentralized and robust infrastructure fully interoperable. However, this is a good example of where insurance can make an interesting, rapid difference. If you just take battery performance, EV owners, trade sellers, fleet operators face high financial risks from battery degradation due to the potential need to make costly replacements and due to the lack of buyer confidence. In practice, most original equipment manufacturer warranties are not satisfactory at all in this regard. They cover limited periods or limited mileages. They're perceived to offer protection only in very extreme cases, leaving asset owners exposed to very significant risks. Now, there is an example, I'm going to cite just one. There are in fact hundreds of operators, innovators happening in this space with all sorts of different interventions on data reliability, on substitution, on battery cell health and so on. But let me pull out an example of an organization in London, in UK, Altelium, which provides battery insights and insurance products to enable faster and safer EV adoption. They partner with Tokyo Marine Kiln. They offer a battery health check with the option to purchase a battery warranty if the EV passes that check. That means they're covering both repair and replacement costs, even if the battery degrades faster than expected. And those kinds of warranties in a market economy reduce financial risks of purchasing and owning. They allow the EV ecosystem to operate more effectively, and above all, they begin to build more confidence, because mostly often what we're dealing with here is risk perception. So that kind of solution that is helping EV adoption by offering financial protection, reducing uncertainty surrounding performance and asset value, builds increased confidence and can then become reflected in price, leading to lower costs for finance purchases of new EVs, and stimulating further adoption and opening up a whole other set of possibilities in terms of the entire markets of reuse and repair when it comes to battery reuse. If you then come to commercial vehicles, including, for example, buses, these account for approximately half of road transport emissions currently. EV adoption has now spread to almost all commercial sectors, accounting for 35% of current sales for buses and 2% of current sales for medium and heavy trucks. But that 2% is far below the kind of aspirational goals and necessary goals that I just outlined for 2030. So again, here, there are really good improvements in terms of battery costs. Total cost of ownership for battery electric vans and trucks is already the same as diesel vehicles for all size vehicles for urban routes and for light duty trucks for regional routes. Again, not data that is well known, but important to be aware of. Electric heavy-duty trucks are expected to have a competitive total cost of ownership for regional and long-haul usage by 2030. However, total cost of ownership is a major economic tipping point for this kind of transition, particularly for buying behavior, and insurance can again help. In this case, battery test and warranty solutions can naturally mitigate the risks, but to improve the economics and accelerate commercial transition, the big opportunity from commercial fleet electrification is to look at optimizing the entire infrastructure by pooling, creating depots, aggregating supply, and aggregating, therefore, risk coverage and insurance. That would lead to self-owned renewable energy generation for solar and wind, commercial scale battery deployments to ensure sufficient capacity and decrease the load of electricity by load shifting. And that creates a material opportunity to then think about how to integrate battery infrastructure in vehicles into battery infrastructure in construction and local energy infrastructure, two-way bidirectional charging, and everything that comes with urban infrastructure. I know you would like me to stop. I'll just finish with one key context in which this starts to get to scale. In a European context, speaking from the work that Climate Kick is doing, we are orchestrating an initiative that has 112 cities committed to completely decarbonize by 2030. There are three sectors in scope: the entire transport system, the entire energy system, and the entire construction industry. What that means is a massive, large-scale opportunity for the kind of financial aggregates, risk management, risk mitigation, market aggregations for commercial-scale battery deployments, for battery deployments across infrastructure, across all of those cities, but particularly to look at a number of intervention points, mitigating the credit risk of offtake commitments by other contracted or commercial authority users, mitigating the risk of service provision by other charging infrastructure suppliers, mitigating the risk of solar panel and commercial scale battery performance by purchasing insurance warranties that guarantee performance, mitigating the risk that tax credits from a lot of these interventions do not necessarily play out as expected, and mitigating risks of allianceships or partnerships, alliancing that needs to come in play when you're looking at that scale of decarbonisation. These kinds of solutions can materially de-risk the entire transition finance and de-risk the acceleration of that kind of real economy decarbonisation. I think there's a couple of reflections that I would really want to make, looking at that sort of aggregate play where it exists. There are opportunities around thinking about large offtakes that can in turn be de-risked by insurance, helping fleet operators engage with cities, thinking about green corridors across these areas where you have multiple cities and regions, you have multiple consumer buyers involved in an urban context or a regional context where they're being encouraged to think about their choices and they need greater confidence. And then the opportunity really for insurers in the Northern Hemisphere in particular to then really step into vertical integration and to start to get all the way through the material supply chain on batteries, on materials in vehicles, for example, de-risk, but also reduce the underlying risk. So the business model goes back to the core asset of insurance, as Rowan mentioned, which is its ability to manage an uncertain future. Start with that principle and shift the Overton window of insurability to anticipate a significantly wider market opportunity to unlock and enable an accelerated transition, reduce the underlying risk, which drops straight to the bottom line of insurers and others. Thank you.
Thank you so much, Kirsten. 112 cities decarbonising by 2030 and insurance being able to help unleash that transition. That's really good. So I'm lucky enough to share with you how insurance can help unlock the capital we need for nature-based solutions and the transition to regenerative agriculture. And I'm a nature-dependent soul. I have to get out and feel the restorative power of nature every week. So this is something that's really close to my heart. To achieve the goals and targets of the Kunming-Montreal Global Biodiversity Framework and the Sharm Agenda, investments in nature need to triple to over 500 billion annually by 2030, and the funding gap to transition to regen ag, which is estimated at close to 250 to 430 billion annually, needs to be closed. De-risking these investments, protecting the nature-based solutions produced, and supporting the integrity and value of new carbon credit markets are all critical to secure the scale and cost of finance required. I'm going to share 3 case studies that illustrate insurance doing this today. Firstly, let's consider mangroves. Investments in mangrove forests often face the risk of hurricanes. For example, in 2002, Hurricane Isidore destroyed 99% of the San Crisanto area's mangrove forests in Mexico, causing significant flooding and bringing local economic activity to a halt. To protect against this risk, AXA Climate, in partnership with Climate Seed, developed an innovative solution to protect the community of fishermen responsible for the restoration of those mangrove forests against the impacts of hurricanes. In the event of a hurricane, this insurance will facilitate rapid financing in order for the damaged mangrove forests to be restored, as well as the repairs of related infrastructure linked to fishing and ecotourism. So how does it work? As soon as a hurricane sweeps through, compensation of up to $100,000 is triggered automatically. Its amount varies according to the wind strength and the proximity to the core of the protected area. Compensation is sent straight to the policyholder, namely the local community in this case, in order to support repair efforts following on from the damages caused. This process supports the regeneration of a thriving ecosystem, while still ensuring the sustainability of the carbon offsets which are associated with it. So this cover protects the mangroves, the financing, the fishermen, the local community, and the natural biodiversity upon which they all depend. Nice stuff, huh? As is well known, carbon credits are a critical source of transition finance, but the integrity of these credits is often questioned. What's less widely known, but it's lovely to hear people starting to talk about it today, is that the value of these carbon credits can be enhanced by insurance protections that not only offer their view on the integrity of the credits, but also provide financial protection should that view be turned out to be wrong. An example of this is the protection placed by Howden related to the carbon credits for the reforestation project of degraded forest lands by Mere Plantations. Mere are a UK-based company that owns and operates a teak plantation, Sustainable, in Ghana, West Africa. Risk covered included fraud and negligence by the developer, amongst others. The value of the credits can be protected against political risk too, and these types of protection have been known to double the value of credits, so represents a material lever to help increase the amount of nature finance available. Moving now to sustainable agriculture. Willis Towers Watson helped sugarcane farmers in Queensland, Australia, reduce the amount and cost of nitrogen-based fertilizer they use, whilst helping ensure that this reduction won't also reduce the yield revenue. Underpinned by over 20 years of sugarcane production research, each policy is tailored to crop location, soil type, and crop start time. Claim payments are triggered by weather measurements by the Australian Bureau of Meteorology, which means the claim process is automated and fast. Farmers don't have to lodge a claim, which increases efficiency for everybody. This solution also helps decrease the nitrogen fertilizer runoff to local Queensland waterways, which is recognised as causing degraded water on the Great Barrier Reef, with all the negative impacts that has for reef health and fish life. In summary, it's a quadruple win. Lower input costs for farmers, net of the insurance premium, more certain costs, more certain yields, and a healthier environment. And these three case studies showcase some of the solutions insurance already has, but I want more. In particular, I'd like to see the industry develop a solution to help unlock the investment required to enable the transition to regenerative agriculture. Such transitions are estimated to provide a positive business case for farmers, resulting in return on investment of 15 to 25% over 10 years. However, during the transition, yields often get worse before they get better, and some new expenses required, for example, the purchase of seed drills. This short revenue hit needs financing, but the majority of farmers don't want to do. The insurance industry can provide a floor on the yield, make investors more remote from loss, and help farmers be confident to take the upside without literally betting the farm. And such a solution, I believe, could be transformational. So there's a lot we can do in the insurance industry, but to scale these benefits, we propose collaboration with existing deal pipelines as part of the Enabling Insurance Breakthrough. For forests, with the Tropical Forest Forever facility and the Regional Platform for Climate Projects. For mangroves, the Mangroves Breakthrough. And for RegenAg, we propose the Action Agenda for Regenerative Landscapes that was launched in COP28. If you know other pipelines we can help, please tell us. Thank you. So I'm multitasking. At this point, let's move please to Hamza Haroon.
Well, thank you so much, and good afternoon to you all, and I really do hope some of you are still awake. That was a joke. Well, thank you so much for also inviting CVFV20 to this amazing discussion, and a very important discussion as well. CVFV20 is now an intergovernmental agency of 70 countries. These are 70 climate vulnerable countries. These are 70 countries that are in a constant loop of what we call a climate debt trap. where you have high debt for these countries. That high debt is also complemented by high interest rates and high cost of capital for these countries, which leads to more debt. And then on top, we see slow onset climate events and episodic events, which continuously keeps them in this loop of climate debt trap. Now, for this important discussion, there are three key pillars that I would really encourage us to ground ourselves when we talk about insurance for these climate vulnerable countries. The first one being de-risking the growth sectors for vulnerable countries under the umbrella of the climate prosperity plans, which is a flagship project of the CVFV20. And when I say growth sectors, I am talking about the energy sector. I'm talking about the infrastructure. I'm talking about agriculture. The second point that I will discuss a bit more about is how can we utilize insurance to reduce the cost of capital for sustainable investments and MDB lending. And the third point is how can we close this financial protection gap through Global Shield against climate risks and disasters that are occasionally taking place and actually have increased in ferocity, increased in numbers in the climate vulnerable countries. But before I proceed, let me talk to you about the climate prosperity plans that we are working on and that we've already delivered for Ghana, Bangladesh, Sri Lanka, and we're also working on almost 10 countries, including Pakistan, to create these climate prosperity plans. These prosperity plans are low carbon development plans. These are the national investment strategies for these countries. We combine and we collaborate and we compile all the bankable projects that are necessary for achieving development and climate goals. And then we go and find the right investors and financing to make sure that those projects happen. What we need to do and what I have seen personally when the Pakistan floods of 2022 happened was the impact the growth sectors had, specifically on agriculture and energy. I have personally seen a power plant being flooded, which caused the entire city to remain pitch black for the next 7 days. And the only thing that was running were the generators humming with their loud noise. So that's the kind of de-risking of growth sectors that is required within these climate vulnerable countries. And the second part is how do we utilize insurance to reduce the cost of capital? And that happens both at micro level and at macro level. At micro level, we're speaking to the farmers who's going to the bank and is getting a really high cost of capital. How can we have insurance de-risk and give that cover to that farmer so that they can proceed even when disasters hit? And at the macro level, how can we ensure that the governments are getting the right lending from these MDBs, from these DFIs to ensure that their climate and development outcomes are being reached? And the last point is closing that financial protection gap. When the floods hit in Pakistan, or when the heat waves hit in Maldives, what I found one thing that was very captivating and very sad to see was that in Pakistan after the floods, only 0.6 to 0.9% of the population was covered by insurance. There was a deep mistrust of insurance, and that led to people not getting insurance. So I'm being told to stop, but what we need to do is really ensure that projects and mechanisms like Global Shields reach out to these climate vulnerable countries so we can protect and have those social protection gaps solved for these communities and for these climate vulnerable countries. Thank you so much.
Thank you very much, Hamza. Let's go to Leslie in the room.
Thank you, Chair. So Leslie apologizes for not having been able to make it. I'm Avinash Ramisa, and I will deputize for him. So at this point of time, your colleague may already be raising his 1 minute flag. I will be short and sweet. So really, I'm here to talk on behalf of all the regional risk pools. So we are development insurers, and our job is to transfer risk from the vulnerable countries to the global markets. So in essence, I'm answering to some of the queries which Hamza had in his speech. So in so doing, our job as well is to improve the financial resilience and the operational resilience of these vulnerable countries with regards to disasters and natural shocks mainly. So we pioneered risk transfer solutions which we provide to these countries. we have shown that the model works, and our global impact, if I just look at my slide, is currently on behalf of all the 4 risk pools. CRIF was the first one in 2007. ARC Limited, which I represent here on behalf of Leslie, has been set up in 2014, and the 2 other ones are more recent entities. So our global impact, we cover 64 countries today. We provide 2.5 billion USD in annual coverage. We cover more than 208 million people, and we have paid out more than 604 million USD since 2007. Only for this year in 2024, CRIF has paid over 100 million USD in terms of payout, and ARC Limited has paid over 67 million USD in terms of payout. So where is the challenge? And what is the conversation that needs to happen? Clearly, we build the engine, we build the plumbing and the piping, to use what Rowan said this morning, but we need fuel, and capital is fuel. Yes, 1 minute. Capital is fuel. So we have to scale up our model. We've shown that it works. We've shown that it serves the interests of the vulnerable countries, but we need assistance and help to scale up the model, first thing. And second, we also need, as discussed this morning, that the commercial reinsurance markets play the game of helping the vulnerable countries beyond the profit angle. So thank you so much.
And thank you so much. Let's move on to Cecilia, please.
Thank you so much. I'm from Financial Sector Deepening Africa. I work in the capital market development team and capital mobilization team. We work hand in hand with the insurance sector team, which some of you may know better as a partner in all of this. And as we work hand in hand, we've seen examples of what you have spoken about, all of you just now, in particular, the function of guarantee facilities and guarantee companies to mobilize, in particular, private sector, domestic institutional capital. We have assets under management of 2.4 trillion US dollars on the US dollars equivalent on the African continent in insurance assets, pension assets, and if guarantees for the coupon and the interest payment of instruments like green bonds, sustainable bonds can be made available, then we can broaden, their investments into different assets. They currently hold about 80% in government securities. That is not necessarily the most productive use. So guarantees can also help the foreign perceived investment risk, which is often a perceived investment risk. So we see that guarantees really help mobilize capital in a real sense. It's happening into sectors, both in mitigation and adaptation, to create the resilience to avoid the problems in the disaster risks in the first place. One other area I wanted to point out is when we work with the sovereigns in Africa, we have a large portion of countries in debt crisis or the risk thereof. And guarantees can really help in the reprofiling efforts and extend maturities, so tenor extension guarantees. So that's obviously a coordinated approach amongst DFIs and reinsurers and insurers to help create that fiscal space again for sovereigns that we need to be able to invest in the green and productive economic sectors that will reduce the disasters in the first place. So we also have examples. So we've spoken about specific risk, specific sector risk products, where East African insurers, the local insurance companies have come together to underwrite, for example, in the geothermal sector. So that's another great example that can also be extended into other sectors, that the wonderful case examples that Craig shared just now. I will stop there. Thank you. I am compliant. He's very, very happy.
Round of applause, I think. Very well done.
Okay, next slide, please.
You get a bottle of champagne for that.
Thank you.
Yeah.
So I'm going to try and be under time. So I'm going to tell you what the hell is the enabling insurance breakthrough all about. Next slide. It's really about how we plan to help mobilize the insurance industry to help us make this transition rapidly. Slide, please. Next slide. Look, yeah. So this is a collaboration between Howdens and the Climate Champions, but it's a big tent thing. And essentially we're focused on three things, which really uses the power of the Climate Champions with the Marrakesh Partnership to make a real difference. It's a radical collaboration across the whole value chain, essentially to close deals, because only by closing deals do we make impact. And we want to do it in a way that we can learn and scale faster. It's about demand aggregation for societally important use cases. The definition of science importance is the Climate Solutions Roadmap, which has been worked out by the Climate Champions and the Marrakesh Partnership. That's what we need to do by 2030 if we're going to have any hope to do what we want to do by 2050. And as a result of working on these deals in a very structured way, we'll work out what works and we'll work out what cannot be solved by the commercial insurance industry. That will enable us to work out if there are policy levers that could make it work, and that would give us a evidence-based policy advocacy strategy, which I think would be much better than a wish list for governments to hear. Next slide, please. So what do we aim to do and how? We aim to make the market we need by informing, inspiring and helping enable practitioners to deliver the 2030 climate solutions fast enough. This is about activity now, impact now. We only deliver impact, not only one deal, but more importantly, one deal pipeline at a time. We do one type of pipeline, we get it nailed, we move on to the next one. And we're going to focus on accelerating the transitions for energy, transport, the built environment, and helping finance and protect nature-based solutions for forests, mangroves, plus regenerative agriculture. And the way we're going to do it is build those significant deal pipelines for societally important use cases. We'll be learning by doing, and once we know what it is, we'll have a machine that we can just apply and let the commercial market move on and unleash that that transition finance we need. We'll be sharing what we learn with the whole market as we go along, so that that success can breed success. But critically, we'll also have a hall of fame, because whenever you try something new, it's one thing reading it in the book. It's very different if you can speak to someone who's done it before and they can say, you know what, it does work. And actually, these are the key things you probably want to know. And we'll be positing those solutions for systemic barriers and promoting policy changes where we believe that's a priority. Next slide, please. And who's going to help make this happen? As I think you all know, we've recently released with Howden and Boston Consulting Group a publication called The Great Enabler, which is a very pretty read and actually a very interesting read. So I do encourage you to read it if you haven't. And we had an incredible groundswell of support from partners who said they believe that what we're doing is valuable and they'd like to be acknowledged. So we're delighted with these. You'll see there's way more people who aren't insurers than insurers. We have bankers, we have philanthropy, we have real economy players, and they only had a week to sign up, right? It's amazing, right? That doesn't happen normally. And, it could be you. If you've heard stuff in this room and you think, wow, that helps, please join us. We need all the help we can, but if we do this together, we can succeed. Thank you. Nigel, over to you.
I'm about as excited as I've been in any climate event I've been in nearly 20 years working in this space. I want to thank all the speakers and all the presenters for the inspiration, really, that there is systemic change that you are already bringing about, and now the job is to really scale it up. So yeah, really, I'm buzzing. This is fantastic, and the great thing is we've got systemic thinking and practical examples, and real change potential in the room that's already underway. So my job is just to not to pontificate, but to moderate. And we've already got lots of people who have got stuff to add. We've got some questions up there, but really it's an opportunity to contribute anything, particularly any thoughts about what else insurance solutions could support, or what you've got to
offer? Because let's make this a generative conversation. If you want to get into specific detailed conversations about the solutions or challenge anything, fine, but I'd like the energy to be about how can we go faster. So what are the pipelines and what have you got to offer? Or what are you already doing that's an offering in this space that means we should have added you to that list already if we had more than a week? Let me, I've got a list of people who've already said they'd like to add something. Let me ask you to keep it to a couple of minutes because I expect there's a few more people who want to put their hands up. I've got 6 or 7 already, but let me start with Louise Walker from the UK FCDO. Louise.
Thank you very much, Nigel, over here. Hi. I agree with you. This has been a very inspiring conversation, and thanks to each of you who are doing this systemic thinking and tough frontline work and problem solving. It's brilliant. So well done. In terms of our offer at the Foreign Commonwealth and Development Office and HMG, we are big on global financial system reform, and insurance and pension funds are a part of that. But insurance, particularly disaster risk finance, but bigger than that, the kind of things we're talking about today in terms of big models for risk transfer that can really bring more capital to the table and potentially drive down the cost of capital, as some were addressing. We have Financial Sector Deepening Africa in the room, which I'm pleased to see is UK funded, as well as beside me the Private Infrastructure Development Group, which is leading the way on some very innovative models, including guarantees, but not limited to that in terms of climate resilient infrastructure. First of all, congratulations on the Great Enabler. It's a report, but it's a movement. So, well done on that. So consider us part of your movement. But I'd like to ask, actually, just one of the pieces you have in there is on data. And in other sessions I've been in, I've been told that risk pricing in the global financial system is just wrong. It's backward looking for emerging markets and developing economies. It's inaccurate. It's perceived risk, not actual risk. And the data isn't there to back it up. So I'd be keen to hear both what you as the insurance industry sitting on so much fantastic data are thinking about in terms of helping sort of square that circle, and as well as looking at future risk, because we are in a world that we've never seen before. So the past is great, but we also have to look at how do we look at the future and structuring our finance around that. But again, congratulations and thank you.
Thank you, Louise. I'll ask the team to follow up directly. And I'll now like to talk to Karen, who I know is a real expert at structuring complex deals in frontier markets. So really, really great to hear some of your thoughts, Karen.
Is this on? Great. Maybe just try to keep it concise. I don't want to see the board warning me on time, so I'll be very concise. I think 2 areas we can definitely see closer collaboration with the insurance industry, and frankly, some of the other panels at this COP has specifically said it's a finance COP, but insurance is part of the financial services industry. So it's not just about banks and pension funds, insurance companies investing. Sometimes if we don't have the risk factors de-risked, you will not see private sector commercial capital flowing. And I remember in London Climate Week, how, I think Rowan gave this example of the coal-fired power plant industry, and the insurance industry actually had to go in, rewrite the fire codes with the city and government's fire departments. And that's how that industry really blossomed, because you're not going to have accidents, right? And insurers have to pay out, and you continue to see insurance availability. And that's what we're seeing right now in insurance availability in many climate vulnerable, maybe not countries, but even states in the United States. So I do think it's extremely important to think about resilience and adaptation. Insurance availability will not be there unless you have smartly invested in climate resilient infrastructure. And this is something perhaps we have to work with FEMA, we have to work with the governments, because ultimately taxpayers have to pay, right? So if insurance industry can collaborate with the banks, and investors and the governments on policy setting and incentive setting to actually say, unless you have climate resilient infrastructure, PNC insurance will not be available, and therefore it will become government's liability and taxpayers' liability ultimately. So let's do this together. And whether it's wetlands, mangroves, nature-based, whether it's, better drainage systems, early warning systems, urban tree canopies, right? So we think about it, climate problem really is a heat and a water problem. So we have to address those issues. If you don't invest in climate resilient infrastructure, adaptation infrastructure, insurance will not be available, be way more costly. I think since 1980, US has 400 plus climate disasters that cost us more than $3 trillion. So, that's 400, by the way, with $1 billion cost or more. Hurricane Helene was about $40 billion disaster damage. So that's one area for sure. Then the investors and banks can come in and help finance those climate resilient infrastructure because there's no revenue stream per se to finance, but it's a reduced cost, present value of that reduced cost stream that we can finance. So I think that's one thing we have to turn it on its head. We have been starting to work with the insurance industry, how to include it on some of those thinking. And then very quickly on the second area is emerging technologies. So we have seen a lot of promising technologies that start to have first of its kind, second of its kind facilities developed, but they can't scale. If they can't scale, we will not be able to reduce the green premiums and make sure that they're commercially viable for bigger projects and therefore making sure those technologies are available for the rest of the world. So the insurance industry has a very critical role to play to provide completion risk insurance and technology risk insurance, because now it's not about demonstrating that we can work on a lab scale or perhaps a very, very small commercial scale. We actually have to make sure when you 10x, 100x something that still works and the project can be completed, because one of the bigger issues we have right now is skills and labor and supply chain. So just because you can build something to capture 4,000 tons of carbon, it doesn't mean you can actually build something to capture 40 million tons of carbon. So a lot of that is pure technology risk, completion risk insurance. I think with that, more financing can go into the valley of death, as we call it, where the commercial capital isn't flowing. So we need that as well.
Great, thank you, Karen. I think that your first example speaks to what Rowan's taught me, that all insurance is always public-private, but the public might be regulations or standards, not necessarily capital. I think so. Thank you for that. Next, I've got Sophie Punt from the Smart Freight Centre. Sophie.
Hello, good to see so many faces. And first of all, congratulations on the new report you just released. I'm the founder of Smart Freight Centre. I founded it 11 years ago because I felt freight and logistics is always an orphan when it comes to climate change. And I've handed it over to Christoph Wolff 2 years ago, and I'm now back on the board. I'd like to tell you the story a little bit from a transport, or particularly freight perspective. And I'd like to use the example of electric trucks because then I feel it's easier for you to understand. A year ago, I did a study called an actionable framework for electric trucks and charging, because I felt that very often NGOs are looking at one barrier at a time. Oh, demand, oh, supply, oh, the grid. Companies don't think like this. They think, are all the boxes ticked that need to be ticked, and otherwise I'm not going to do it. And one of those boxes was finance. Yeah. And then what happened this year, Smart Freight Centre worked together with Bloomberg and the Dutch Ministry of Infrastructure to do a research on how do we make electric trucks investable. And the conclusion from the study is that zero emissions trucks are very viable assets, but there are barriers. And the three barriers that they really came out with from a financing perspective, one is the capital cost and the TCO. So even if the total cost of operation is positive, very often a carrier cannot afford the $250,000 it needs to buy the truck. Why? Because they have maybe 1 year contracts. So it's both. Then the second one is that the refueling or recharging is about 10 to 70% of the TCO. And because that's such a big variety, it becomes also very difficult for them to get insurance or financing. And the third one is then the battery residual value, because of course the industry in freight is that you buy a truck and very often it gets resold after 3 years to the next one and to the next one. And you see that everywhere around the world. So if you don't know what the battery is going to be worth, it's very difficult to invest because You have no guarantee. So what the idea of what I think really needs to happen next is to understand the risks that are associated with electric trucks and understand which ones are real and which ones are perceived, and then and make sure you cover all risks. And what Smart Grid Center is now doing in India is setting up with a number of insurers and financial institutions a risk-sharing facility for zero-emissions trucks to try and reduce those barriers for investments for carriers. And we picked India because of the size of the market, but also because we think we finally really should give priority to some of the developing countries now instead of first doing this in the West. And the final point I wanted to make is that can we please look at this holistically? When I did the interviews of a number of companies and others about what are the risks associated with electric trucks, the one word was mentioned, fire. Yeah. So we talk about depot charging, but I've talked to logistics service providers who want to do depot charging. They can't get insurance because of the fire risk. And everybody's talking only about financing. They're missing a big gap. The other one is extreme weather. We've heard Valencia, right? If what happens when an electric truck gets flooded? Is it still worth anything? So what I really think we need now is to make sure that we get a blueprint that you mentioned, Craig, but that it covers all the risks, not just about mitigation financing, but all of them. And I would then call it a combination of all in and insurance, called all insurance. And I then think you have a really good viable value proposition, not just for electric trucks. You could apply this to any technology. Thank you.
Great. Thank you, Sophie. Very practical example. I'm going to turn now to Kevin from TNC.
Okay, thank you. So quickly, and I wish Junaid was still here. Can you still hear me? I just had lost a wire. There's a natural way to look at this with insurance coming into the private sector, but the public sector is obviously, we all know, suffering greatly. The debt is too high. What I do is I work on the debt conversions that swaps the bonds, the euro bonds into lower debt, and we use that savings to finance climate and conservation for the countries, and we help them achieve their goals. It was an extreme case, and I wouldn't look at this as a case study, but the first deal I did was in Belize, and in that transaction, we reduced Belize debt to GDP ratio almost 10% in that transaction and created $180 million over the next 19 years for conservation and climate. So looking at, kind of what is new and what building on what is old, there are models where the private sector can actually leverage the MDBs in the public sector through reinsurance, right? MEGA does it all the time. DFC does it all the time. DFC just did a $1 billion deal that I was not involved with in El Salvador, where they probably reinsured out $500 million worth of risk. I'm guessing when we did the $500 million deal in total, there was $250 million, and we reinsured, or they reinsured out. So there are real solutions where the private sector can come in, and I think this has to be part of the NCQG strategy, is to get more of these MDB and get it off of their balance sheets, not just reinsure out, but actually put the rules in that if you're going to reinsure out with a double and a triple A, stable of reinsurers, then you should take that off your books, and you should take that out of the envelope that the countries have, so we can create more money and move that forward. There is about to be a deal that will come out shortly, I believe, that will have not just a reinsurance, but a co-insurance strategy in that, and maybe some philanthropy in there. So that will be another role they can play. And then finally, there is a task force that we have that we put together last COP with all of the credit enhancers. It would be great to have a parallel task force with the market of reinsurers and insurers, if we could do that.
Great. Thank you, Kevin. There's so much rich content here. I'm just saying, I do hope we're recording all this. I've got 5 more people who've said they want to speak, so please keep your remarks brief to respect the other 4. I'm going to start with Isaac Anthony from Seacliff. Is Isaac here?
Please spoke on behalf of.
You already mentioned Seacliff. Great, thank you. So let's go to Paulu from PCRIC. You've already said that. Yeah, right. Okay, we can relax a little bit. We've got 2 minutes each. Amal from the Climate Champions team wants to add some comments. Amal, thank you.
Thank you. I think in addition to what has been said in the context of what we're discussing here, I think one basic but important piece is to make sure to leverage or to bridge the knowledge gap. I know we are talking about this in the context of climate finance in general, and this applies also to the insurance in the sense that there are different pieces being worked on, but I'm not sure the beneficiaries totally get it, totally get what's in there for them, totally get how to access. And I have to acknowledge that initiatives like the Great Enabler that we are seeing is making it more relatable in the sense that this is something that they can project to their own realities. And I wish with the help of all the stakeholders here and with the richness we have in the room that we are able to provide more diversified examples, especially in the global south and especially when it comes to adaptation and resilience being an area where the financial sector still do not dare that much to take the risk. And I think that as much as blended finance has now become a buzzword in a way, in a good manner, I think it is important to leverage on this momentum and to find a place for insurance to also take on this piece and instead of having another more complex process in a siloed way. And as much as we are talking about making sure that the NAPs are investable, it is important to find the component and how to find this missing piece of puzzle and make sure that the insurance piece plug in there so that it helps. And then instead of trying to reinvent the system and it is important, and we've talked about having insurance added to the table, but I think there is also a bigger room for it to own it further, especially when it comes to what we are discussing in COP. This is my first COP, and I think this is the first year where I finally hear a lot about insurance, be it in London Climate Action Week and here today. And I think it is great to get this close, but then also to acknowledge and to recognize the players and to come together. We've been talking about partnerships today, and I think this is a great momentum also to leverage on that and to simplify language, focus more on adaptation, and to come together to push towards this further. Thank you.
Thank you, Amal. I fully agree. There's a lot of misunderstandings or lack of understanding about insurance and the range of products and the range of risks. So there's definitely a role to simplify and translate. Two last interventions. First from Julian from Munich Re Green.
Hello, Julian Richardson, Chief Underwriting Officer at Munich Re. I'm actually sitting here feeling quite proud of what we do in the insurance industry because at Munich Re, we touch on so many parts of the discussion. We are the reinsurer of MEGA. We reinsure Africa risk capacity. But let's talk about insurance as a whole. What is it? It's a huge pool of capital. It's a $3 trillion pool of capital that has fundamentally been underused to support capital deployment in climate-friendly technologies. It's been underused in disaster risk finance. And we are fundamentally exposed to the risks of climate change. Our business is taking weather risk and natural catastrophe risk. We are the largest underwriter of natural catastrophes, and we know that climate change is having an impact on the frequency and severity around those areas. It's always a difficult about attribution, but we know it's a thing. So we care about climate change, and it's important to our business. Importantly, insurance has a number of things. It sends price signals about risk, about the cost of risk. We also have insights and data that we can share to help inform clients about their own risks. We do enable capital deployment. Nothing gets invested without it being insured. And what is resilience finance if it's not insurance? We know.
If I can ask you just to wrap up quickly, we understand what you are. If you could say something to one of the questions, that'd be great.
Okay, so we know that the resilience finance is about bouncing back, and that's fundamentally what insurance does. So we're able to bring these new technologies, this capital solutions to bear. We underwrite thousands of renewable energy projects. We know the oil and gas industry was using insurance as a way of de-risking it. So we must do the same in the climate world.
Thank you, Julian. And final intervention, Rob Cameron from Nestle.
Thanks, Nigel. Thank you, Nigel, and good afternoon, everyone. I want to pick up on what Craig was talking about. Craig talked about nature-based solutions, and particularly regenerative agriculture. And Witness, they are very engaged in this transition, probably the biggest transition in agriculture for 100 years. It's massive, and we know it's important for mitigation reasons, but it's also important for adaptation and resilience. The very steps you would take will also ensure resilience in the future. Here's the good news. We know that the insurance industry has a role to play in this transition because we've already been using it for weather-related insurance, micro-level weather-related insurance based on parametrics. So if the rainfall hits a certain level in a given period of the year, the farmer gets the payout, and the micro premiums ensure affordability and will support it. So we know it works, but it's pilot scale. Lots of farmers are benefiting. The scale of the challenge that you talked about. So I've been thinking a lot about the challenges. Why is it we're not able to scale this up more quickly? And I've concluded that the problem probably lies at our end. We are uniquely ill-equipped and ill-structured to embrace this new way of thinking about what insurance could do for us because of where the different people sit who are busy doing the buying of insurance. So whilst I think there's a role on the industry to come up with new products and services, there's a hell of a role for us because how we've been buying insurance for the last 50 years is totally not how we need to buy it in the future. There's a massive disconnect internally that colleagues like me, and indeed in my peer set like Diageo and PepsiCo and others, we need to work on that on our side of the house as well. So that's the challenge that we need to overcome. Thanks, Nigel.
And thank you, Rob, for ending on what is very, very rare in my experience is a bit of self-examination to recognise that we've all got things to unlearn and learn if we're to make systemic change. I appreciate that, the spirit of that. And with that, thank you so much for all those amazing interventions. We could have gone on for another hour easily, but let me hand over to wrap things up to Anthony Hobley, Deputy Chair of Howden Climate Risk and Resilience, and also the co-leader of the Champions work on the Great Enabler. Anthony.
Yes. Thank you, Nigel. Well, first, just thank you to the Champions team, to BCG, to my co-lead, Craig. This wouldn't have happened without him. And every single one of you, I think most of whom we've spoken to over the last year, every single one of you, and many others not here, have contributed to this. And I think the fact that this is the first time it's on the agenda, I really believe this is one of those critical missing jigsaw puzzle pieces. So very quickly, there's far too many points I think here to really get everything, but I love that point you made. It's not just a report, it's a movement, and if we hadn't got that across, we'd have failed. So I think that's critical. This is public-private. I mean, insurance, I've heard this, but particularly from Rowan many times, as has Nigel, that the insurance is about how we pool, risk, and that can be totally public, it can be public-private, it can be entirely private. We need to make that decision. The other thing I picked up, I mean, this came up from Karen, this came up from Junaid, leverage. Actually, I don't believe we get that public-private leverage without the insurance piece. I mean, Rowan gave us a history lesson, which is pretty critically important. It's yin and yang, or if finance is Popeye, insurance is a spinach. So, finance, if you want to put muscles on, you need your spinach. We need a Back to the Future DeLorean that's going to take us back to how insurance used to operate in a very innovative way. Rob, I mean, the regen piece, that biggest transformation, people don't make those changes unless someone can give them comfort. And I think that's the critical piece. And I think, again, you hit the nail on the head. We've always approached this, and the way we built the enabling breakthrough is demand supply. You can't make any change by just concentrating on the supply side or the demand side. Actually, it's not just the insurance industry that needs to transform and in a sense raise its game and be at the table as opposed to just in the room. It is also the demand side have to better understand, because as Craig illustrated, as our report illustrates, as I think we've learned over the last year, we have 70% or more of the actual solutions. I think we thought at the beginning of the year, if this is not happening, if insurance is not really de-risking, it must be because we don't have the mechanisms. We do. they're just not being deployed. And the reason for that is both sides. And so we all have to raise that capacity and understanding. We heard from Sophie, Kirsten, many others about the supply chain piece, the systemic piece to this, the fact that we can't underwrite every specific project. We need to take that systems-based approach. Risk and barriers is one of the key things that's challenging the supply chain. So we need to aggregate at the city level, at the country level, at the corporation level. Going to stop. There's a lot more. There were many more points. Apologies to those I couldn't get in. Well, maybe so the data point actually is critically important, because the current insurance model of annual renewal is not just about data. It's then about how we use that data. The one industry who knows how to take data and translate that into what it means in the one language that people speak when they make decisions is the insurance industry. That language is dollars. And in my view, all of that stuff we're generating, TCFD, TNFD, ESG, until you translate it into that language of dollars, it might as well not be there, because it's not relevant when people make those asset allocation, business decisions, investment decisions. And actually, I think that's just to a large degree, not exclusively, that's the insurance industry's job, but the current model doesn't incentivize them to do that. Can please the speakers, everyone who spoke, contributed, please stay behind, because we want to get a family photograph outside. Yes, just outside. Please gather outside. We're going to get a family photograph of everyone. Thank you so much.
I will make Oh, thank you so much for coming. We're on the way. The movement is underway. Thank you so much. Thank you for coming. Hello, I'm Ryan. Glad to see you. Well done, gentlemen. What a duo. You made it. Fantastic. It's great.
Hi, I'm Fiona.
Ladies and gentlemen, kindly I ask you to go out, because there's another session going on right now. Please. Distinguished guest, can I ask you to kindly go out? There's another session going on right now.
One last thing, he said the speaker. He said outside. Outside. Things you let outside. Okay.
So for the family photo, if the speakers could very quickly assemble in front of this wall here and then leave, because we do need to vacate the room for the next session. Family photograph over here, ladies and gentlemen. Right. Family photograph. Just come over here.
Yeah. Yeah. Well, I think that would be.
I think we'll just use this. Stop with the law.
I think like Can you see Jimena?
Yeah, I need to switch them now.
What if the